It's Friday the 14th of March, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, the world after Trump, so the key global economic drivers over the long term. But first, Neil Shearing, Group Chief Economist, joins me for another trawl through macro and markets. Hi there, Neil. How's it going?
Hi, David. All good. How are you?
Yeah, good. Busy week, busy times. I wanted to start with the US, where recession is trending on Google as a term. We're forecasting a pretty big contraction in Q1, and every day it seems you've got consumer-facing firms warning about signs that people are getting nervous. Putting it all together, what are the risks to the US economy?
I think it's going to be an extremely bumpy path ahead. So if we look at the data that's come in over the last couple of weeks or so, as you say, it's pointing to a pretty significant contraction at this stage. Now, one should never overweight 1 or 2 months worth of data, but at this stage, it does look like GDP is tracking at something like minus 1% Q on Q annualized in the first quarter of the year. And in particular, it's consumers that look like they're pulling in their horns. Now, we'll get more data on that in the coming weeks when we get retail sales numbers for February. But if we look at some of the higher frequency data, for example, the CARTS data from the Chicago Fed, that's pointing to a pretty chunky fall in spending in February, retail spending in February. So it looks like consumers are pulling in their horns. Now, the question really, I think, is this the start of a more fundamental downturn in the US economy? Or is it just some disruption caused by uncertainty around tariff policy? And I think the key question to my mind is, what has changed that would usher in a downturn in the US economy? Clearly, the Fed has not been tightening policy, it's been loosening policy. For all the talk of cuts from Doge, actually, we're not yet seeing those come through in the economic data. And there's not really been a shock from overseas either. So I don't think fundamentally a lot has changed. This is really about the uncertainty generated, I think, by some of the administration's policies. Now, once that settles down, I suspect we'll get a rebound in Q2. Indeed, that's what we have in our forecast. So it's not a US recession as such at this stage, but it is a pretty bumpy path ahead. And if we get that softer data next week on retail sales, as we expect, then it's going to make for more turbulence in markets.
So to be clear, because there was some talk, wasn't there, that what we're seeing in the first quarter would reflect the fact that imports were so strong, that there was tariff front running, and that skewed the data, and that it would all snap back, unwind as the months went on. But you're saying that we are seeing signs that things are softening. That February data on Monday, do you think that's going to swing the debate? It does sound like it's going to be quite a key release, doesn't it?
It will be a key release, and you're right that there were at least 2 things happening in some of the January data. There was the thing that really shocked the market initially was the big downward revision in the Atlanta Fed's GDP nowcast, so this real-time measure of GDP growth, that stemmed from a surge in imports in the January trade data without an offsetting rise in inventory investment. Now, if all of that sounds a bit technical, essentially what it seemed to be saying was that US firms were apparently front-running the tariffs by increasing imports in January, but we didn't get an offsetting rise in inventories in US firms. So that might just be a timing effect, but obviously the rise in imports subtracts from GDP. The inventory investment would be a positive for GDP, so those 2 things should net out. They didn't in January. We might get some of that rebound in February. The second thing that's happening, though, is this weakness of consumer spending. Now, we had some soft retail sales numbers in January. That was partly, we think, weather-related. We had severe winter weather in January, so partly weather-related. But as I say, some of the more recent numbers on consumer spending for the high-frequency numbers for February look soft too, and we'll get confirmation or not of that in the February retail sales numbers, which will come in the week ahead.
And the FOMC is going to have that data when it goes into its meeting this coming week. We've also had 2 inflation reports over the past week. Jerome Powell saying, quote unquote, the economy is in a good place, but also warning about elevated uncertainty. What do you think will be the outcome of this FOMC decision? Perhaps less so in terms of what the policy decision is and more how the sort of communications with which it's packaged.
Yes, I think it's the communications that's key. I don't think anybody is expecting a change in interest rates at this juncture. So it's the communications that will be key. Now, I suspect you've just outlined exactly how they will communicate this, which is some of the income and economic data perhaps exaggerates the extent of weakness in the US economy. If you look at some of the labour market data, it's suggesting that it's holding up reasonably well. In the past week, we've had job openings, vacancies data that have been reasonably healthy, so suggesting that the labour market's cooling, but certainly not collapsing. So I think we'll get a repeat of that message from Powell that some of the recent economic data have been weak, but the economy fundamentally is in a reasonable place. On the question of what the next move in interest rates will therefore be, I think given that the elevated uncertainty around tariffs, given it looks likely that tariffs will rise after the April the 2nd report is filed to the administration on these various trade investigations, and that will push up at US CPI. I just don't see that there's a window for the Fed to cut interest rates unless this weakening in the data, economic data from the real economy extends across the first half of the year into the second half, and it's a more fundamental downturn in activity in the US. So if the real economy kind of muddles through, we get a bit of a rebound in Q2. I don't think there's a window for the Fed to cut. If the Fed does end up cutting, it's going to be because the economy doesn't muddle through. Actually, it softens and weakens a lot more than we expect. And I think that's the scenario that's now being increasingly priced into markets. If you look at the degree of rate cuts now priced into the market 3 this year, if you look at what's happened to the equity market, I think the markets have taken the view that the US economy is heading for troubled waters. Our view at this stage is don't read too much into a few weeks worth of data. And as I say, we expect a bit of a rebound in Q2.
On central banks more generally, because we've got the Bank of England as well this coming week, but I thought it was interesting. We had a Bank of Canada decision over the past week, 25 basis point cut as we've been forecasting. But the sort of rhetoric around that was quite revealing. You've got Tiff Macklem, the governor, talking about the limits of what rate cuts can do to sort of offset the growth impact of a trade war, and how the bank needs to stay vigilant on the impact, the inflationary impacts of all these tariffs going up, of higher tariffs. To what extent is that going to be a sort of standard play for central banks going forward?
Yes, I think that probably is how central banks will play this. Their view is likely to be that trade wars are something that started by governments and exacerbated by government policy, and there's not really a role for them to play here in terms of either preventing it or indeed much they can do to cushion the fallout. Now, this partly depends upon the mandate of the central bank. If it's an inflation mandate, pure and simple, then that's what the central bank has to weigh. And the question then is the extent to which tariffs imposed on the country in question by the US has significant implications for inflation through a contraction of export demand, therefore weaker GDP growth and falling inflation, offset potentially by tariffs imposed as retaliatory measures by the home government that would push up inflation. So lots for central banks to weigh, partly depends on their inflation mandate. But fundamentally, there's not much that monetary policy can do to counteract the effects of tariffs, I don't think. It's much more a job for fiscal policy. And in the case of Canada, there's actually some room for fiscal policy to expand to counteract the effects of tariffs imposed by the US. But by the same token, if we get the 25% tariff that Trump has talked about across all sectors and it stays in place for a significant period of time, the disruption that's going to cause, frankly, there's not much that either fiscal policy or monetary policy could do to prevent a recession. So not much the central banks could do, a bit more that governments can do if they have the fiscal space. But if the tariffs are really ratcheted up and your trade ties with the US run deep and are wide, like Canada, then frankly, there's not a great deal that either monetary or fiscal policy can do to offset a recession.
The other big event for the coming week, it's actually looking like another busy week, is China data coming out of China, industrial output, retail sales, fixed asset investment data coming Monday for the January-February period. They squish it together on account of the Spring Festival holidays. But we've also got our China activity proxy coming, I think, towards the end of the coming week. We've also just had the National People's Congress wrap up this past week in Beijing. It's the annual gathering of the leadership to set out priorities for the coming year. What's the mood music around China for the coming year? What are we expecting from the data?
The data so far look to have been pretty soft in the first few months of the year. Now, that comes with the caveat that data at this time of the year from China is affected by the Lunar New Year holidays, which has a disruptive effect on the data. So sometimes difficult to, you have to look through that. But adjusting for that, taking that into account, it does look like the data have been softer. The PMIs suggest weak growth, bit of a slowdown, and some of the spending data have been a bit soft too. The National People's Congress, as you say, has just concluded. We have the broad outlines of fiscal plans for this year where it looks like there'll be fiscal support, perhaps equivalent to about 1.5% of GDP. That sounds large by the standards of advanced economies that we're used to in terms of fiscal stimulus plans, but it's pretty small by China's standards. Put all that together, it looks like it's a soft start to the year. We should get a bit of a pickup in activity over the coming months and quarters as some of that fiscal support feeds through, although the timing's still a bit uncertain. But fundamentally, the economy, I think, is still in a pretty weak spot. The composition of that fiscal support is going to be really key as well. At the moment, it looks like it's going to be weighted very heavily towards public investment and infrastructure. And frankly, that's not what China needs. It needs more consumer spending. That's the pathway to faster growth and a sustained rebound in the economy. So a bit of a pickup coming perhaps in the coming months after a soft start, but fundamentally, I don't see that we're going to get this big reinvigoration of economic growth that some are hoping for in China.
Okay, I want to wrap up this week with possibly the most frequently asked question that we've had over the past few weeks, and it's all about defense spending. Obviously, lots of headlines about governments ramping up spending on security in the wake of signs that the US may be withdrawing its security backstop. We're going to have a lot more to say on this issue, obviously, and it is an evolving issue. But as a first swing, how transformative do you think this news about a ramp up in defense spending is going to be? You read the headlines, you think about examples like what rearmament did for the UK economy in the 1930s. Is that the kind of impact that we're thinking about?
The short answer is no, probably not. That's not to say this is not significant. I think in the case of Germany, it potentially is significant. But of course, Germany is the one major economy in Europe that has the fiscal space to really expand, to really increase spending. Most other economies within Europe are much more fiscally constrained. That includes the UK, where after much wrangling, there's been an agreement to raise defense spending from a target of 2.5% of GDP to 2.7% of GDP over the next couple of years. So pretty small stuff. So I think that there's a slight danger of projecting what's happening in Germany onto the rest of Europe in particular, where there's much less fiscal space to raise spending on defence to the same extent. And to the extent that spending is increased on defence, then I think it's much more likely that other parts of spending is going to have to be squeezed. That was the case in the UK, where, of course, aid spending has been squeezed to make way for spending on the military. So that's the first point. Other countries are unlikely to follow to the same extent in Germany's footsteps. The second point is that although some of these numbers, particularly from Germany, look large, the so-called fiscal multiplier, so this is the bang for your buck in terms of GDP that you get for every increased pound in spending on defence. The fiscal multiplier is quite low. Various estimates, but tends to be somewhere around 0.5 to 0.7. So for every $1 of extra spending on defence, you get perhaps 50 or 70 cents worth of additional GDP. So a low fiscal multiplier means that even if you do get a big increase in defence spending, the bang for the buck in terms of GDP is relatively limited. So not to say this is not big deal in the case of Germany, it is. And I think that there will be a significant shift in attitudes towards defence spending, particularly across Europe over the coming years. But does that radically transform the economic landscape? Probably not at this stage.
Neil Shearing there on the macroeconomic implications of higher defence spending, as well as US recession noise, central bank policy, and China's choppy 2025. On defence spending, as I said, we're going to have much more to say on this as the situation evolves, but an in-depth report went out this past week from Vicky Redwood, who's our senior economic advisor. I will post that to the podcast notes. On central banks, look out for our drop-in. That's one of our short-form online briefings. This coming Thursday, the 20th, that's just after the Bank of England announcement, in which the team will be taking your questions on the most recent Fed, Bank of England and ECB meetings. Details in the show notes. No doubt you'll have questions about Fed policy and US recession risk in light of that February retail sales data that Neil was discussing. A bit after we spoke, we got those eye-opening consumer confidence numbers from the University of Michigan with plunging headline read and rising inflation expectations, so plenty to chew over there. And if the time doesn't work for you, as with all of these sessions, register anyway and you'll get a recording as soon as it's over. Neil and I didn't get into how recession talk is affecting market sentiment. Obviously, it's been a lousy start of the Trump administration for US equities. It's something I discussed with the markets team in a drop-in over this past week. If you missed that, I will link to the recording as they do get into issues like whether US exceptionalism is dead and how our bullish end 2025 S&P forecast is looking in light of the sell-off in recent weeks. Our China activity proxy I mentioned, that's our proprietary read of what's really happening in the Chinese economy. It presents a very different picture than what the official GDP data say and has come to be relied on by clients with China exposure, so it is well worth following if you're not already. I will link to our interactive CAP dashboard for those with data access. And if you want to get the CAP and plug its data into your workflows, then do speak to your account manager and we will get you set up. Now, the news cycle at the moment is frankly overwhelming, and it's all down to the whims of one man. As a public service from us here at Capital Economics, we'd like to take you away from the current chaos and look far into the future beyond the Donald Trump administration to see what the global economy looks like. Our long-run coverage is designed for investors with long-term horizons, and each year the team refreshes its assumptions about global economic outcomes to 2050 and beyond. Now, the team's just published this annual exercise as a major report with accompanying forecast data, and it's titled Global Megatrends Will Outweigh Trump Disruption. Ariane Curtis, a senior economist on our global team, is one of the co-authors of this report, and I spoke to her earlier. And I started by asking why the legacy of Donald Trump's policies will be outweighed in the coming years and decades by bigger forces.
Yeah, so it's true that Trump's policies are probably going to have an effect on some economies, especially in the near term. You can think of Canada, Mexico, obvious cases, given their dependence on the US as an export market, China as well. And of course, in the near term, this could lead to some uncertainty, which would weigh on investment decisions and reduce global growth a bit. But really the key thing is when we take a step back and look further out into the coming decades, our view is that Trump's policies aren't really going to affect the global order too much, in the sense that we don't think it will mark the beginning of a period of deglobalization. Trade won't be particularly affected in the long run. So it's really the case that we don't think Trump will mark a permanent shift in US trade policy. We think it's more likely that the global economy will continue to fracture into these two US-led and China-led blocks rather than the US bloc splintering. And we think that tariffs are probably going to be rolled back, at least to some degree, after 4 years. So instead, it's really the case that these megatrends, we have three that we can think of, which are demographic outlook, the AI revolution, and the fracturing of the global economy. And these are really going to be the bigger determinants of the economic outlook in the coming decades. So they're going to have a much bigger impact than, for example, tariffs further out. And just briefly on these three, really demographics-wise, it's going to be a case that aging domestic populations in many advanced economies, most notably Europe, Japan, and also in China, is going to weigh on growth prospects there. Whereas in some other Asian economies and in some emerging markets, particularly in sub-Saharan Africa and in Asia, there's a much better demographic outlook. So that kind of pushes up growth prospects in those countries. In terms of the second megatrend, which is AI, we have done a lot of research in the past into kind of the AI boom, and we think that it will really materialize in the next decade, in the 2030s, and that's going to boost productivity growth, especially in advanced economies and the US in this kind of period of 10 years. And then finally, as I mentioned, fracturing is going to be a big driver of global growth prospects. And we think the world economy will continue to fracture into these US and China blocks, which will cause some reorientation of supply chains, especially in strategic sectors, but really that it's unlikely to have a big impact on globalization or trade in the long run, as I mentioned. But the fracturing will have some implications for different economies. And in particular, we think that given the US bloc's economic size and also the diversity of the economies within those blocks, we think there would be a smaller hit to productivity from fracturing there than in the China bloc, which kind of helps explain some of the regional divergences there.
So lots of noise coming from the White House, but we have to bear in mind that there's a sort of near-term impact, but looking out over decades rather than months, quarters, even a couple of years. Very different story where you've got, as you say, these mega trends. Quantifying all of that, when we think about winners and losers, if we look at the global economy in 2050, how much will, say, that the top 10 of biggest economies look different from today, bearing in mind all you've said about these mega trends?
Yeah, so if we think of the major economies, number 1 and 2, we don't see changing. So we think the US will still be the largest economy in the world by 2050. And that's partly because the US is going to benefit, as I said, from the AI-driven productivity boom, but also the fact that the outlook for China, which is currently the second largest economy in the world, and we think will continue to be, the outlook there is quite poor. So it's actually, we don't think, going to really gain much ground in terms of the size relative to the US economy. In China's case, that's because there's some headwinds from worsening demographics, the impact from fracturing, and the increasing unsustainability of the country's high investment-led growth model. So really, without a significant rebalancing towards consumption, trend growth is going to slow quite sharply there to about 2% by the end of this decade. We do have some changes when we think of the third to fifth largest economies. So India, which is currently the fifth largest economy in the world, we think will become the third largest already by 2030, surpassing Germany and Japan. And really, it's going to grow quite strongly from there, and the gap will widen quite a bit. So by 2050, we think it will account for about 10% of global GDP, which, I mean, if you want to think, where does that sit relative to size of some other economies, that would be larger than the entire Eurozone bloc at that time. And so in India's case, what are the main drivers of our pretty positive outlook there? It's the fact that demographics, the outlook is a bit brighter there. There's also the potential for India to develop its manufacturing sector, which should help unleash higher productivity there. And also, it's one of the economies that we think could benefit from friendshoring of manufacturing supply chains away from China and into some EM. So those are where we see some changes in the rankings in the next couple decades.
Okay, I just want to alight on one of the megatrends you talked about, because we have spent a lot of time considering AI as a driver of economic growth, as a transformative force in economies. But separating the hype from the reality, that the signal from the noise in the current parliament, because there is still a big debate, isn't there, in the market about exactly how transformative AI is going to be. Give us a sense of why we're so bullish in terms of its ability to change the global economic narrative over the long term.
Yeah, really, it does come down to the fact that when we underwent this project on AI, we determined that we do think it's going to prove to be a genuine general purpose technology, or sometimes referred to as GPTs. And that really means that the impacts of AI aren't just going to be felt in the technology sector, but really across a wide scope of kind of sectors across the economy. So because of this, we think that this kind of productivity boom I mentioned in the 2030s is especially going to boost growth in those advanced economies, which we estimated to be best placed to benefit from AI. So unsurprisingly, the US will be the main beneficiary. We have productivity there, for example, peaking at about 2.5% on average in the 2030s. And there's some other economies like Singapore, Korea, the UK, which are also, we estimate to be pretty well placed to benefit from AI. And then there's also recently been this question of what about China? The news that we got earlier this year of DeepSeek we think is a good example of, yes, we think China does have the ability to innovate in AI. We had already expected that based on the work we did in our CEAI Economic Impact Index, where it scored actually very highly in that category. But it hasn't changed our view that China will lag in its ability to really diffuse and adapt to the technology, which is equally as important as innovating. So because of that, we still think, even with the news of DeepSeek, that it will hold back some of the potential productivity gains that China could get from AI relative to the US or some of those other economies I mentioned. But I would say that one kind of potential bigger implication from the news we've had from DeepSeek is that either with DeepSeek or other low-cost, open-sourced advanced LLMs, this would really show that maybe AI could become more accessible to some countries. I'm predominantly thinking of some emerging markets who don't actually develop the technology themselves, but that they could roll it out at a more low-cost, efficient way, and that could potentially lead to some bigger productivity gains there than otherwise.
That was Ariane Curtis on the long-run economic outlook. I will link to the report in the podcast notes. The markets version of this report is coming in April, where we're going to have a lot more to say on where equities, bonds, and FX are heading in the coming decades. If you want access to this coverage, the written report, the forecast data, and in fact to all of our coverage, do check out CE Essential and CE Advance. These are our all-access packages. They give you the fullest possible picture of what's happening in global macro and markets, along with a full suite of data tools to help deepen your understanding and get your work done more efficiently. And on top of all of that, you get extensive engagement options, so you can basically plug our Economist team directly into your workflow. Speak to your account manager to see how CE Essential or CE Advanced can start helping you today. But that's it for this week. Neil and the team will be back on the podcast next week for more on global macro and markets, and undoubtedly the latest from Trumpland. But until then, goodbye.
Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.